something significant has shifted in the financial markets. And if you're watching this, you likely already sense it. This isn't about chasing the next trade. This isn't about getting rich quickly. This is about understanding a structural change that's been building quietly beneath the surface of traditional financial systems, one that most investors won't recognize until it's already reshaped their portfolios. My name doesn't matter. What matters is the framework we're about to walk through together. Because whether you already hold this asset or you've been watching from the sidelines, the decisions you make in the coming months will be shaped by how well you understand what's actually happening right now. Let me be direct. I'm not here to sell you anything. I'm here to help you think clearly during a period when most people won't. There's a pattern unfolding across global markets that connects futures positioning, institutional accumulation, sovereign debt pressure, and monetary policy in ways that don't make headlines until it's too late. Most retail investors look at price charts and feel confused. They see volatility and assume chaos. But beneath that surface noise, there's a coordinated movement happening between Chicago and Shanghai, between traditional finance and emerging monetary alternatives that tells a very different story. Here's what you need to understand first. Markets don't move randomly. They move in response to capital flows, institutional positioning, regulatory shifts, and most importantly, the slow-motion crisis building in the global debt markets. The CME and Shanghai futures markets aren't just trading venues, they're signaling mechanisms. They reveal where large capital is positioning before that capital fully commits. And right now, those signals are pointing in a direction that contradicts what most financial media is reporting. You've heard that markets are cyclical. You've probably heard about 4-year patterns, halving events, bull and bear seasons. All of that matters. But what's happening now transcends simple cyclical thinking. We're in the middle of a debt spiral that no major economy has successfully escaped in modern history. Global sovereign debt has crossed $35 trillion in the United States alone. Europe faces its own mounting crisis. China's property sector represents the largest debt bubble in human history, and central banks everywhere face the same impossible choice. Do they continue expanding the money supply to service debt, knowing it debases the currency? Or do they tighten policy, knowing it triggers recession and defaults? This isn't theoretical. This is happening right now, and it's creating the exact conditions that push institutional capital toward alternative stores of value. The CME data shows something remarkable when you know how to read it. Large non-commercial traders, the institutional players, the hedge funds, the sophisticated capital, have been building positions through derivatives markets in ways that suggest they're not speculating on short-term price movements. They're hedging systemic risk. Shanghai's role in this story is less understood but equally important. As China navigates its own economic challenges, capital controls have tightened. But capital always finds a path. The Shanghai Exchange doesn't just serve Chinese speculators. It serves as a window into how global capital is repositioning away from traditional yuan and dollar dominance. When you see coordinated movements between CME positioning and Shanghai volumes, you're watching institutional money flow across borders in real time. This isn't about East versus West. This is about global capital seeking safety from coordinated monetary debasement. The playbook isn't complicated. It's simply been hidden in plain sight. When sovereign debt reaches unsustainable levels, governments have only 3 choices: default explicitly, default through inflation, or restructure through currency devaluation. History shows us which option they always choose. Let's step back and talk about why any of this matters to you. Inflation isn't just rising prices at the grocery store. Inflation is the silent transfer of wealth, from savers to debtors, from the middle class to asset holders, from the prepared to the unprepared. When central banks expand money supply, which they must do to prevent debt defaults, they dilute the purchasing power of every dollar, euro, and yuan in existence. This isn't a conspiracy. This is basic monetary economics. But here's what most people miss. Not all assets respond to inflation equally. Stocks can offer some protection, but they're tied to earnings and economic growth. Bonds get destroyed by inflation. Real estate works until interest rates rise. Gold has worked for thousands of years, but it doesn't offer the portability or divisibility that modern capital demands. This is why institutional investors have been quietly accumulating scarce digital assets over the past several years. Not because they believe in a revolutionary ideology, but because the math simply works. When debt grows faster than GDP, when money supply expands faster than productivity, when every major economy faces the same structural problems, capital needs somewhere to go that can't be printed, can't be confiscated easily, and can move across borders instantly. Let's talk about interest rates for a moment, because this is where many investors get confused. When the Federal Reserve raises rates, people assume risk assets should fall, and in the short term they often do. Higher rates mean higher discount rates for future cash flows, more expensive borrowing, slower economic growth. But here's the trap. Central banks can only raise rates as long as they can afford to service their own debt. The US government now spends over $1 trillion annually just on interest payments. At 5% rates, that number becomes unsustainable quickly. This creates what economists call fiscal dominance, a situation where monetary policy becomes constrained by the government's own debt burden. The Fed can't truly fight inflation with sustained high rates because doing so would bankrupt the Treasury. So what happens instead? They raise rates temporarily, call it victory when inflation moderates slightly, then pivot back to easing before the debt crisis explodes. This cycle has repeated throughout history, and it's repeating again now. Smart investors understand this trap. They know that rates will eventually have to come down, not because inflation is conquered, but because the debt burden demands it. And when rates fall while debt continues expanding, that's the exact environment where scarce assets flourish. Every major currency is losing purchasing power, but most people don't feel it immediately because it happens gradually, then suddenly. The dollar has lost 98% of its purchasing power over the past century. That's not a failure, that's the design. Inflation allows governments to repay debt with cheaper currency. It's a hidden tax that most citizens never see coming, but institutional investors see it clearly. They measure their wealth not in nominal terms, but in purchasing power. They don't care if their portfolio grows 10% if inflation runs at 8%. They care about real returns after inflation. This is why the smart money has been moving into assets with provably finite supply. When you can verify mathematically that no more than a certain amount will ever exist, you found a hedge against unlimited monetary expansion. The CME futures data reveals that sophisticated players aren't betting on short-term volatility. They're structuring long-dated positions that suggest they expect sustained currency debasement over years, not months. Let me address something important. Cycles still matter, but they're misunderstood by most people who talk about them. Yes, there are observable patterns in market behavior. Yes, certain events create predictable supply shocks. Yes, sentiment swings between greed and fear. But treating these cycles like clockwork is a mistake. Markets are driven by human psychology layered on top of fundamental supply and demand. The psychology creates volatility. The fundamentals create direction. Right now, we're in a phase where retail sentiment remains relatively subdued. The euphoria of past cycles hasn't returned. Mainstream financial media still treats this asset class with skepticism. These are typically signs of mid-cycle consolidation, not late-cycle excess. Meanwhile, institutional adoption continues quietly. Exchange-traded products are accumulating supply. Corporate treasuries are allocating percentages of reserves. Sovereign wealth funds are exploring positions. Banks are building custody infrastructure. This divergence, retail caution while institutional accumulation accelerates, is precisely what happens during the early and middle stages of major market shifts. By the time retail sentiment turns euphoric, the smart money is already positioned. There's an industry of analysts making bold predictions with absolute certainty. They'll tell you exactly where price is going, exactly when it will get there, and exactly what will happen next. Let me tell you what experience has taught me. Certainty is the enemy of good decision-making. Markets are probabilistic, not deterministic. We can identify high probability scenarios based on historical patterns, macroeconomic forces, and market structure. But we cannot predict with certainty. What we can do is prepare for multiple scenarios. We can understand which forces are likely to drive long-term trends. We can position ourselves to benefit from those trends while protecting against unfavorable outcomes. The analysts who get it right aren't the ones making the boldest predictions. They're the ones who understand risk management, who build positions gradually, who maintain emotional discipline when everyone else is panicking or euphoric. The CME Shanghai Playbook isn't about knowing the future. It's about understanding what institutional capital is protecting against and positioning accordingly. If you're already holding, this section is for you. Let's talk about what this environment means for your position. First, understand that volatility is a feature, not a bug. Assets in their price discovery phase will always experience significant drawdowns. That's not weakness. That's the market searching for equilibrium as new capital enters and exits. Your job isn't to predict every swing. Your job is to understand whether the fundamental thesis remains intact. And right now, every macro indicator suggests that thesis is strengthening, not weakening. Debt is accelerating. Monetary policy remains accommodative despite tough talk. Institutional adoption is expanding. Supply dynamics are exactly as predictable as they've always been. And most importantly, the structural problems that make this asset attractive aren't going away. They're intensifying. This doesn't mean price can't fall in the short term. It absolutely can. Markets overshoot in both directions. But if your holding period is measured in years, not months, then short-term volatility is simply noise. The question you should ask yourself isn't, what will happen tomorrow? The question is, do the conditions that drove me to hold this asset still exist? If the answer is yes, then your strategy shouldn't change. Let's be honest about the emotional challenge of holding through significant drawdowns. It's difficult. It tests your conviction. It makes you question your decisions. This is why understanding the macro thesis is so important. When you truly comprehend why you're holding, temporary price fluctuations become less distressing. Think about what you're protecting against. You're protecting against currency debasement, against sovereign debt crisis, against the slow motion collapse of purchasing power that happens when governments choose inflation over default. These problems don't disappear during market corrections. They continue building. And that means the asset you're holding continues serving its purpose even when price is falling. Professional investors call this mark-to-market versus mark-to-model thinking. Amateurs obsess over daily price changes. Professionals focus on whether their underlying model, their thesis about how the world works, remains valid. If your model says that scarce digital assets will benefit from ongoing monetary expansion and debt crisis, then temporary price weakness is actually an opportunity to add exposure, not a reason to panic. Now let's talk to those who don't yet hold this asset but are considering it. Your situation requires a different framework. The worst mistake you can make is entering emotionally, either from fear of missing out or from panic about economic collapse. Both emotions lead to poorly timed decisions and excessive position sizing. Instead, approach this systematically. Start by educating yourself thoroughly. Understand the technology, understand the monetary economics, understand the difference between speculation and strategic positioning. Then ask yourself, what percentage of your portfolio makes sense for an asset this volatile? For most people, that number is somewhere between 1 and 5%, enough to matter if the thesis plays out, small enough that you can hold through drawdowns without losing sleep. Next, consider your entry strategy. Trying to time the perfect entry is a fool's errand. Professional investors use dollar cost averaging for exactly this reason. It removes emotion from the equation and allows you to build a position gradually, averaging your entry price over time. Don't wait for price to fall to some arbitrary level that feels right. That level might never come. Instead, decide on an allocation and build it methodically over weeks or months, regardless of daily price movements. Let's talk about risk management, because this is where most investors fail. Risk isn't about avoiding volatility. Risk is about position sizing relative to your personal financial situation. A 20% drawdown in a 1% position is uncomfortable but manageable. A 20% drawdown in a 50% position can be catastrophic. The probability that scarce digital assets significantly appreciate over the next 5 years, given current macroeconomic conditions, is reasonably high. But the probability of significant volatility along the way is nearly certain. Your strategy must account for both. This means holding a position small enough that volatility doesn't force you to sell at the worst possible time, but large enough that appreciation meaningfully improves your financial position. It also means having the discipline to rebalance. If your 1% position grows to 5% of your portfolio, consider taking some profits. Not because the thesis has changed, but because risk management demands it. Professional money managers don't just think about potential upside. They think constantly about downside protection, liquidity needs, correlation with other holdings, and tail risk scenarios. Let's return to the core insight that sparked this discussion. The coordinated positioning happening across institutional venues. When you see large non-commercial traders building significant long positions on CME futures, that's not speculation. These are entities managing billions in capital. They don't gamble. They hedge systemic risk. When you see Shanghai volumes correlating with price strength rather than weakness, that's telling you capital's flowing into this space despite regulatory uncertainty, not away from it. When you see exchange-traded products accumulating supply faster than new supply enters the market, that's creating a structural squeeze that must eventually resolve through price discovery. These aren't coincidences, they're signals, and the signal is clear. Institutional capital is positioning for a world where traditional stores of value prove insufficient. This doesn't guarantee immediate price appreciation. It means the foundation is being built for sustained long-term demand that will eventually overwhelm available supply. Let me share some historical context that might help you understand what we're experiencing. Every major currency crisis follows a similar pattern. First comes denial. Authorities insist everything is under control. Then comes creative accounting. Debt gets repackaged. Liabilities get pushed off balance sheet. Metrics get redefined. Then comes the inflation phase. Authorities claim rising prices are transitory, while quietly expanding money supply to service debts. Finally comes the recognition phase, where capital flees to assets that can't be debased. We've seen this pattern in Weimar Germany, in 1970s America, in Latin America repeatedly, in Zimbabwe, in Venezuela. The specifics differ, but the structure remains constant. Right now, we're in the late inflation phase moving toward recognition. Most people still don't see it because they're measured changes against nominal currency values rather than purchasing power. But institutional capital sees it clearly. That's why sovereign wealth funds are diversifying reserves. That's why corporate treasuries are exploring alternatives. That's why the CME futures market shows positioning that anticipates long-term currency weakness. I want to emphasize something that might sound counterintuitive. Patience is your greatest advantage as an individual investor. Institutions face quarterly reporting requirements, investor redemption pressures, mandate constraints. They must often trade around these limitations rather than simply holding optimal positions. You don't have these constraints. You can build a position and hold it through volatility without answering to anyone. You can ignore quarterly performance and focus on multi-year outcomes. This is an enormous structural advantage, but only if you actually use it. Most retail investors squander this advantage by trading too frequently, reacting to news, trying to optimize every entry and exit. The investors who build generational wealth aren't the ones who trade the most. They're the ones who identify high-conviction asymmetric opportunities and hold them patiently while thesis plays out. Let's spend a few minutes talking about what you should absolutely avoid during this period, because understanding what not to do is often more important than knowing what to do. First, do not react emotionally to daily price movements. If you find yourself checking price multiple times per day and feeling anxiety or euphoria, your position is too large. Scale it down until you can sleep peacefully. Second, do not over-leverage. Using borrowed money to increase exposure feels smart during rising markets and catastrophic during corrections. Leverage turns volatility into forced liquidations. Professional investors use minimal leverage, if any. Third, do not chase headlines or react to news in real time. By the time something is widely reported, institutional capital is already positioned around it. News doesn't move markets. It explains moves that already happened. Fourth, do not follow online personalities or social media hype. The loudest voices are rarely the most knowledgeable. They're optimizing for attention, not accuracy. Make decisions based on fundamental understanding, not influencer opinions. Fifth, do not try to time perfect entries and exits. And the cost of being out of position during significant moves far exceeds the benefit of avoiding minor drawdowns. Build positions gradually and hold them patiently. Sixth, do not invest money you might need in the next 12 to 24 months. Volatility is certain. Having to sell during a drawdown because you need liquidity is how wealth gets destroyed. Only allocate capital you can truly afford to leave invested. Seventh, do not stop educating yourself. Markets evolve, regulatory environments change, new information emerges. Staying informed is part of the process. But staying informed doesn't mean obsessively consuming content. It means regularly updating your understanding of fundamental drivers. We need to talk directly about the elephant in the room. The global sovereign debt situation is not sustainable under any reasonable scenario. When debt to GDP ratios exceed 100%, economic research shows that growth slows, crisis probability increases, and governments face increasingly difficult choices. The United States, Japan, Italy, Greece, and numerous other nations are well beyond this threshold. The traditional playbook for escaping debt burdens involves growing your way out, expanding GDP faster than debt grows. But that's mathematically impossible when debt compounds faster than economic growth, which is exactly what's happening now. That leaves only the options mentioned earlier: explicit default, restructuring, or inflation. History is unambiguous about which option governments choose. They always choose inflation because it's politically palatable. Citizens don't understand it. They blame businesses for raising prices rather than governments for debasing currency. This isn't political commentary. This is economic reality. And it's why institutional capital is moving toward assets with provably finite supply. Some investors worry that regulatory crackdowns could undermine this entire thesis. Let's address that concern directly. Regulation is coming. In fact, it's already here in various forms across different jurisdictions. But regulation doesn't eliminate the asset, it legitimizes it. When traditional financial systems create frameworks for custody, taxation, and compliance, they're not killing the alternative. They're acknowledging its permanence and integrating it into the existing structure. Some regulations will be poorly designed. Some will create short-term price pressure. But the fundamental thesis doesn't require regulatory absence. It requires recognition that this asset class serves a function that traditional systems can't replicate. Institutional capital isn't frightened by regulation. Institutional capital requires regulation. They can't allocate significant resources to assets operating in legal gray zones. Regulatory clarity, even if imperfect, enables rather than prevents institutional adoption. Let me offer you a framework that might help during periods of uncertainty. Separate your investment horizon from your information consumption. If your holding period is measured in years, consuming information daily creates a fundamental mismatch. Daily information is noise. It's random fluctuation that means nothing for long-term outcomes. This doesn't mean ignoring markets entirely. It means developing the discipline to focus on signal rather than noise. Signal is policy changes, macro trends, institutional adoption, supply dynamics. Noise is daily price action, social media sentiment, pundit predictions. Most investors do the opposite. They obsess over noise while ignoring signal. This leads to emotional decision-making and poor outcomes. Train yourself to consume information at the same frequency as your decision-making. If you're not planning to adjust your position for 6 months, Consuming daily information serves no purpose except to create anxiety. Let's talk about risk-reward asymmetry, because this is what sophisticated investors actually optimize for. An asymmetric opportunity is one where potential upside significantly exceeds potential downside. If you risk $1 to potentially make $3, and the probability is reasonably balanced, that's an asymmetric bet worth taking. Given current macroeconomic conditions, the thesis we've discussed offers profound asymmetry. The downside scenario is that traditional systems stabilize, debt gets managed responsibly, currencies maintain purchasing power, and alternative stores of value remain niche. In that scenario, a small allocation underperforms but doesn't destroy your portfolio. The upside scenario is that debt spirals continue, currency debasement accelerates, and capital flows massively into scarce alternatives. In that scenario, even a small allocation dramatically improves your financial position. This asymmetry is why position sizing matters so much. You don't need to bet your entire portfolio to benefit from asymmetric opportunities. Small positions in high-conviction ideas often generate the best risk-adjusted returns. If you've made it this far, you're probably someone who values understanding over entertainment. That's good. That's the mindset that survives volatile markets. The disciplined investor doesn't need excitement. They need clarity. They need frameworks for thinking about uncertainty. They need permission to act slowly and thoughtfully rather than impulsively. Everything we've discussed comes down to a simple framework. Understand the macro forces at work, position appropriately for your situation, maintain emotional discipline, and think in years rather than months. This isn't complicated, but simple and easy are different things. Maintaining discipline when markets are falling takes emotional fortitude. Avoiding euphoria when markets are rising takes self-awareness. Thinking independently when everyone has an opinion takes confidence. These are skills you develop over time, not innate abilities. Every market cycle teaches you something about yourself if you're paying attention. The path forward. So where does this leave us? What should you actually do with this information? For those already holding, continue your plan. Revisit your thesis regularly to ensure it remains valid. Rebalance if position size grows beyond your risk tolerance. Ignore short-term volatility. Think in cycles and years. For those considering entry, start educating yourself deeply. Understand what you're buying and why. Decide on appropriate position sizing. Build positions gradually through dollar cost averaging. Remove emotion from the process. For everyone, stay informed about macro developments. Watch institutional adoption signals, monitor debt dynamics and policy responses, but don't let information consumption create anxiety. Information should empower decision-making, not paralyze it. Most importantly, understand that this isn't about getting rich quickly. This is about protecting purchasing power over long time horizons while potentially benefiting from a major structural shift in how capital perceives value. Let me leave you with a final thought about perspective. We're living through a period of monetary transition that happens perhaps once or twice per century. And these transitions are always chaotic. They're always confusing. They always create winners and losers based on who understands what's happening and who doesn't. The CME Shanghai Playbook we've discussed is just one lens for viewing this transition. It's a way to see what institutional capital is doing while most people remain focused on daily news and price movements. But the real insight isn't about trading strategies or investment tactics. It's about understanding that the financial system is fundamentally changing in response to unsustainable debt dynamics, and that change creates both risk and opportunity. Your job is to position yourself thoughtfully for that change, not recklessly, not emotionally, not based on fear or greed, but based on clear-eyed assessment of probability, appropriate risk management, and patient execution. The crisis isn't coming. It's already here. It's unfolding slowly in debt dynamics, currency debasement, and the quiet repositioning of institutional capital. Most people won't recognize it until the transition is complete. But you have the opportunity to recognize it now, to understand what's happening beneath the surface, to position appropriately while maintaining emotional balance and risk discipline. This doesn't require special access or insider information. It requires paying attention to what markets are actually showing you rather than what headlines are telling you. The CME positioning, the Shanghai volumes, the institutional accumulation, these are breadcrumbs marking a trail that leads somewhere specific. Where that trail ends, nobody knows with certainty. But we can estimate direction, prepare for multiple outcomes, and position accordingly. That's not market timing. That's intelligent risk management during a period of significant structural change. Whatever you decide to do with this information, do it thoughtfully, do it with appropriate position sizing, do it with emotional discipline, and most importantly, do it with a clear understanding of both what you're trying to achieve and what you're protecting against. The investors who navigate this period successfully won't be the ones who predicted every move. They'll be the ones who understood the underlying forces, positioned appropriately, and maintained discipline when everyone else lost theirs. Stay informed, stay disciplined. Stay focused on what actually matters rather than what's merely loud. And remember, understanding cycles and preparation matter infinitely more than reacting to noise. Thank you for your time and attention. Use it wisely.